December 26th, 2025. Something broke in the silver market tonight. Not quietly, not gradually, but unmistakably. Shanghai silver touched $85 per ounce. At the exact same moment, COMEX paper price in New York sat at $71. Read that again. $85 versus $71. A $14 gap. In a market where arbitrage is supposed to erase price differences measured in pennies, this is not noise. It's not volatility. It's a structural failure. And it may be the clearest signal yet that the paper market is losing control to physical reality. Let's establish the numbers. Shanghai Futures Exchange, silver price hit $85 per ounce, converted from CNY to USD. COMEX spot price at the same timestamp, $71 per ounce. The premium, 19.7%. We are crossing the 20% threshold that signals systemic breakdown. Historical context matters here. Normal premiums between Shanghai and COMEX ranged 2 to 5%. Even during the 2011 squeeze, when retail demand exploded and mints couldn't keep up, the premium peaked at 12%. This isn't a one-day spike. The premium has been climbing for weeks, refusing to close. November baseline sat around 6%. December saw acceleration to 10%, then 15%. Now we're at 20%. That persistence changes everything. The gap should vanish in hours. Traders buy cheap in New York, ship metal to Shanghai, sell expensive, pocket the spread. That's how arbitrage keeps markets honest. That's how prices stay aligned. Except the metal isn't moving. The gap didn't close. Not in minutes, not in hours, not overnight. It persisted. And persistence is the market's verdict. Failed arbitrage isn't a pricing issue, it's a confidence issue. It tells us physical supply can't meet financial promises. Paper claims exceed available metal. The delivery mechanism itself is under strain. And when a $14 gap refuses to close, the market is screaming one message. The metal isn't available at the paper price. COMEX registered inventories are already thin. Eligible silver, metal in vaults, but not available for delivery, is high, but eligible doesn't matter. Registered silver, the metal actually available for delivery, is what counts, and it's bleeding out. Every delivery request tightens the noose. Each arbitrage attempt doesn't fix the problem, it exposes it. Each successful shipment makes the next one harder. Shanghai contracts are physically settled. Buyers expect delivery. Industrial buyers don't show up to speculate. They show up to secure supply. Solar manufacturers, EV producers, electronics firms, they're locking in metal they actually need. Shanghai prices reflect what it costs to get silver in hand. Right now, that cost is $85. COMEX is different. More than 97% of its contracts never result in delivery. They're rolled forward, offset, cash settled, netted out. Price discovery there is driven by leverage, not availability. That system works until it doesn't. Tonight, it didn't. The premium isn't just a number, it's a warning. One market is asking, what does it cost to get metal right now? The other is asking, what do we need the price to be so the system keeps functioning? Markets can ignore reality for a while. They can smooth it over with leverage. They can mask it with volume. They can postpone it with settlement games. But they cannot ignore it forever. The math is undeniable. $85 in Shanghai is not a fluke. It's the real price. $71 in New York is denial. The paper market is losing authority. Physical reality is asserting itself. And when that handover completes, it won't happen politely, it won't happen gradually, it will happen all at once. Arbitrage requires three things: capital, metal, and the ability to move it. All three are breaking down simultaneously. Start with settlement risk. COMEX contracts are 97% cash settled. No metal changes hands. Shanghai contracts are physically settled. Buyers expect delivery. Traders can't exploit the gap without securing actual metal. And COMEX registered inventory is thin. Each arbitrage attempt drains vaults further. Each delivery request tightens the noose. Each successful shipment makes the next trade harder. The mechanics matter here. A trader sees the $14 gap. They buy a COMEX contract at $71. They plan to take delivery, ship the metal to Shanghai, sell at $85. Simple math says they pocket $14 per ounce minus costs. But the moment they request delivery from COMEX, they're pulling from registered inventory. If registered inventory drops too low, the exchange faces a delivery default. So each arbitrage trade that works makes the system more fragile. The gap should attract arbitrageurs. Instead, it's warning them away. Logistics and timing create another barrier. Shipping silver from London or New York to Shanghai takes 4 to 6 weeks. By the time metal arrives, the premium could reverse or widen further. Traders can't hedge that timing risk in a market moving this fast. The premium hit 10% in early December. It's 20% now. That's a doubling in 3 weeks. No trader can lock in a 4-week shipment when the spread is moving 3% per week. The volatility kills the trade before it starts. Regulatory barriers compound the problem. China's capital controls limit how much USD can flow in for commodity purchases. Traders need approval to move large sums. That approval takes time. By the time it clears, the opportunity is gone. VAT on imported silver adds 13% to the landed cost in China. Import licenses, customs inspections, refinery certification, each step adds friction. Even if the paper math works, the real-world costs and delays kill the trade. The proof is in the persistence. If arbitrage were possible, the gap would close. It hasn't. Not in days, not in weeks. That persistence is the market's verdict. The metal isn't available at the paper price. Arbitrage isn't failing because traders are lazy or stupid. It's failing because the conditions that make arbitrage work no longer exist. Consider what this means. In a functioning market, price differences between exchanges get erased by traders moving metal. That's how global commodity markets stay aligned. When arbitrage stops working, markets fragment. Each exchange starts pricing based on its own supply and demand dynamics. Shanghai prices reflect physical scarcity. COMEX prices reflect financial positioning. They're no longer connected by the flow of metal. They're disconnected by the absence of it. This is the late stage of a squeeze. Early stages show small premiums that come and go. Middle stages show persistent premiums that widen slowly. Late stages show explosive premiums that refuse to close. We are no longer in the early or middle stage. We are watching the late stage unfold in real time. The system is straining. Arbitrage is the release valve. When the release valve fails, pressure builds. And when pressure builds in a market with rigid supply and inelastic demand, the outcome is always the same. Repricing. Not gradual, explosive. Not polite, violent. Not negotiated, forced. Shanghai's premium reflects what it actually costs to secure deliverable silver right now. COMEX's price reflects what the paper market needs the price to be to avoid chaos. One market is pricing physical reality. The other is pricing financial survival. That divergence exposes the core problem. Supply can't meet the promises written on paper. Start with COMEX registered inventory. It's down to multi-year lows. Eligible silver, metal in vaults, but not available for delivery, sits high. But eligible doesn't move unless owners release it, and they're not releasing it. Registered silver, the metal actually available for delivery, is what matters. And it's bleeding out. Every delivery request pulls from that shrinking pool. Every ounce that leaves makes the next delivery harder. The data is clear. Registered inventory dropped 40% in the past 6 months. That's not gradual attrition. That's systematic drainage. Industrial buyers are taking delivery. Investment funds are taking delivery. Refineries are taking delivery. And the metal isn't coming back. Once it leaves the vault, it enters private storage or gets consumed in manufacturing. It doesn't return to the exchange. Industrial demand is the pressure point. Solar panel manufacturers, EV producers, electronics firms, they're not speculating. They're securing supply because they need the metal to keep factories running. TopCon solar panels use 50-80% more silver per unit than previous designs. This isn't a marginal increase, it's a structural shift in consumption. And manufacturers can't substitute. They can't redesign overnight. They can't shut factories down. If silver prices double, production doesn't stop. Margins compress, but the metal still gets consumed. This demand is price inelastic. That's the critical point. Like when oil prices spike, people drive less. When wheat prices spike, bakeries reformulate recipes. When silver prices spike in an industrial context, production continues. Because the cost of silver in a solar panel or an EV battery is a fraction of the total product cost. A manufacturer won't halt a $30,000 vehicle over $200 worth of silver. They'll pay the premium and keep producing. Supply rigidity compounds the problem. More than 70% of global silver production comes as a byproduct of copper, lead, and zinc mining. Silver output depends on other metals being profitable to extract. Higher silver prices don't magically create new supply. They depend on base metal economics, primary silver mines. The ones that target silver specifically take 10-15 years to develop. Exploration budgets have collapsed. Ore grades are declining. Permitting is slower than ever. Environmental reviews stretch timelines. Community opposition delays projects. The supply curve isn't flexible, it's rigid. Recycling doesn't fill the gap. Less than 20% of used silver gets recovered. The metal is dispersed across millions of products in tiny quantities. It's not economical to extract. A smartphone contains 0.3 grams of silver. Even at $85 per ounce, that's 90 cents worth of metal. No one is recycling phones for silver. Industrial scrap from manufacturing gets recycled. But consumer products, the metal is lost. The supply-demand picture is stark. Rigid supply, inelastic demand, shrinking inventories, and a paper market that's been writing promises against a metal pool that's running dry. Shanghai's $85 price isn't speculation. It's the market pricing and scarcity. It's what buyers have to pay to secure metal today. COMEX's $71 price is the fiction required to keep the system stable, but fictions don't survive contact with physical reality. And physical reality is asserting itself right now. Paper markets only work as long as people believe in them, believe that contracts can be delivered, believe that settlements will be honored, believe that somewhere, somehow, the metal exists inside the system. Paper price discovery isn't anchored to metal, it's anchored to trust. And when physical buyers stop believing that story, they don't argue, they don't complain, they don't wait for clarification, they walk away. That's exactly what's happening now. Shanghai is becoming the price setter, not because it's bigger, not because it's louder, but because it's real. The $85 price reflects delivery stress. The $71 price reflects financial denial. Physical buyers are making a choice. They're choosing the market where metal actually moves over the market where promises get rolled forward. History is clear on the sequence. Every commodity squeeze follows the same script. First, physical tightness appears. Then, paper markets dismiss it, spreads widen, arbitrage fails, confidence erodes. And then, repricing turns violent. We've seen this in 1980, we've seen it in 2011, and we're watching it again now. The script doesn't change, only the actors and the timeline vary. The gold-silver ratio sits near 50 to 1 right now, wildly out of alignment with the historical 10-15 to 1 average that held for 2,000 years of monetary history. Every single time the ratio stretches this far, it resolves the same way, not with gold collapsing, with silver surging violently. In 1980, silver went from $6 to $50 in months. In 2011, it went from $17 to $49 in weeks. Parabolic moves, vertical charts, panic buying. The pattern repeats because the mechanics repeat. Repricing doesn't arrive politely. It doesn't climb $1 at a time. It doesn't wait for analysts to update models. It doesn't give shorts time to exit calmly. It arrives in jumps, $4, $6, $10, sometimes in a single session. Because when shorts rush for the exit in a thin market, there's no depth waiting for them. No bids, no buffer, no safety net, only air. This is the late stage of a squeeze, and every data point confirms we are no longer early in that sequence. Volatility isn't weakness, it's stress made visible, and stress is now everywhere, in spreads, in inventories, in delivery mechanisms, in arbitrage failures. The system is straining, the premium is the proof. And when trust finally breaks, the repricing won't ask for permission. $85 in Shanghai is not a fluke. It's the real price. $71 in New York is denial. The paper market is losing authority and physical reality is asserting itself. This isn't a chart pattern or a technical setup, it's a regime change. And when physical reality collides with paper leverage, physics always wins. The market has spoken, and it's speaking louder every day.